Okay, let's unpack this. We're diving deep into the latest from the Reserve Bank of India's Monetary Policy Committee meeting. It just wrapped up today, June 6th, 2025.
Yep, fresh off the press.
We've got the official resolution and the governor's statement right here. Our mission really is to pull out the key bits from these sources, understand what they decided, why they decided it.
And get the RBI's take on the economy where we are now and where things might be heading. These documents, they're always packed with detail, aren't they?
They really are. And here's where it gets, well, really interesting this time. The absolute headline grabber from this meeting is a pretty big move on interest rates. According to the resolution, the MPC decided to cut the policy repo rate by a substantial 50 basis points.
Wow, 50 points.
Yeah, bringing it down to 5.50%, effective immediately.
Okay, and the sources explain how that ripples through, right? That one move means the standing deposit facility rate, the SDF.
Where banks park extra cash.
Exactly. That automatically goes to 5.25%, and then the MSF rate, the marginal standing facility, and the bank rate, basically the RBI's lending rates to banks.
Right.
They both move up to 5.75%. So that whole corridor shifts down.
Okay, so a big cut. What are the sources saying is driving this? Why make such a significant move right now?
Well, the resolution is very clear. It links it straight back to the RBI's main goals, hitting that 4% CPI inflation target.
Medium-term target.
Well, while also, supporting economic growth, the classic balancing act.
Have 50 basis points. That feels more confident than usual. Does the source material give a specific reason for that level of confidence?
It absolutely does. The detailed rationale points squarely at the inflation picture. Headline CPI inflation, the sources say, has really softened.
How much?
It hit a nearly 6-year low, 3.2% year-on-year in April 2025.
And they called out food inflation specifically, didn't they?
Right.
Hitting something like a 42-month low.
Exactly, 2.1% in April. But the key thing, I think, from the sources isn't just that inflation is low now. It's that the MPC feels really confident about it staying aligned with the 4% target. Durably aligned.
Durably, okay.
They even say they think it might undershoot the target slightly this year. So this much better inflation outlook compared to what they thought before is explicitly what gave them the policy space for this cut.
Got it. So confidence on the inflation front is huge. What about the other side, the growth picture? You mentioned the outline suggests growth is okay, but maybe not meeting aspirations.
That's the other piece of the puzzle, according to the documents. I mean, the provisional GDP numbers look pretty healthy, 7.4% in Q4 of the last fiscal year,
Right.
leading to 6.5% for the full year 2024-25.
Yeah.
And they're projecting 6.5% again for this year, 2025-26.
So decent numbers.
Decent, yes. But the resolution states that the growth momentum is seen as, well, lower than what they'd ideally like, especially with the tricky global environment out there.
Ah, okay. So they see room, maybe even a need, to give growth a bit more of a nudge now that inflation seems, under control.
Precisely. It's that combination. A better inflation outlook, creating space, and a desire to push growth a bit closer to potential. That's the core logic laid out for this rate cut.
Now, there was another really important change mentioned in the sources running alongside this rate cut. The monetary policy stance itself.
Yes, that's right. They shifted it from accommodative to neutral.
Okay, from accommodative to neutral, that sounds significant too.
Yeah.
What did the sources say about why they made that shift?
This is quite telling, actually. The sources are very direct about it. They point out that they've already cut the repo rate by 100 basis points pretty quickly since February 2025.
Right, 250 basis point cuts then.
Exactly. And after doing that, they state that under current circumstances, monetary policy now has, and this is their phrase, very limited space left to support growth further through rate cuts alone.
Okay. So after that quick easing, they're basically signaling, we've used a lot of that tool for now.
That's certainly the strong implication from the text. Moving to neutral means they're stepping back from that default easing bias.
So what now then?
From here on, they say they'll be data dependent, carefully watching incoming numbers, the evolving outlook, and then deciding, balancing growth and inflation without that preset lean towards cutting. And they mention the fast-changing global scene really demands that kind of flexibility.
Right, makes sense. So rate cut and stance change, those are the big actions. But the sources also give us this incredibly detailed economic assessment that underpins it all. Let's dig into that. Maybe start with the global picture they're seeing.
Sure. The sources mention that global uncertainty, while maybe having ebbed a little bit since the last meeting.
Okay, slight easing?
Slight easing, yeah. maybe some tariff reprieves, a bit of optimism on trade talks. But they stress it's still elevated, still high enough to dampen sentiment and drag down global growth forecasts.
And they back that up with evidence.
They do. They point to the big international bodies revising forecasts downwards, like the OECD trimming global growth to 2.9% for 2025, the IMF down to 2.8%.
Wow.
And the WTO is actually forecasting a small contraction in world trade volume this year.
Oof. Okay.
So yeah, that pattern of downward revisions really hammers home the point about continued global fragility. They do note market volatility has eased off recently, which is good. Equity markets recovered a bit, oil prices softened.
But gold prices?
Yes, interestingly, gold prices remain high, persistently high, which, often signals some underlying nervousness or uncertainty persisting.
Okay, so that's the global backdrop. Let's shift focus domestically. The sources seem to paint a picture of resilience here, even if aspirations are higher. They mention those GDP numbers again.
Yes, that robust 7.4% in Q4 2024-25, leading to the 6.5 for the full year.
And looking ahead to this year, 2025-26.
The expectation, based on the sources, is that economic activity should keep its momentum going. They point to key drivers: private consumption staying strong, fixed investment gaining traction.
Yep.
They also expect rural demand to pick up, partly thanks to a good agricultural outlook, while the services sector continues to power urban demand.
And they have specific indicators for this, high-frequency stuff.
Yep. Things like capital goods production and imports jumping up sharply in April, strong growth in steel and cement use last quarter, e-way bills increasing, and solid PMI numbers for both manufacturing and services in May. It paints a picture of activity holding up.
You mentioned the agricultural outlook. The sources sound quite positive there.
Very positive. They highlight the forecast for an above-normal monsoon this year, its early arrival, record wheat production already in the bag, and high food grain stocks with the FCI. All good signs for food supply and potentially rural incomes.
But despite this domestic strength, the sources do flag risks, right?
Oh, absolutely. They don't ignore the downsides. Geopolitical tensions dragging on, global trade uncertainties, potential weather issues, those are all listed as challenges.
But on the flip side, any positives?
On the flip side, yeah, they see support from things like ongoing trade deals, specifically mentioning the recent FTA with the UK.
So weighing all that up, what's the overall growth projection?
For 2025-26, the sources project real GDP growth at 6.5%. They even break it down quarterly. Q1 at 6.5, Q2 slightly higher at 6.7, then 6.6 in Q3, and 6.3 in Q4. And importantly, they see the risks around the 6.5 projection as evenly balanced.
Okay, 6.5% with balanced risks. Now let's circle back to inflation domestically. We touched on the headline number dropping to that 3.2% low in April.
Yes, and as we said, driven largely by food inflation coming down for the sixth month in a row, hitting that 2.1% 42-month low.
Right.
Interestingly, though, the fuel component, which had been negative, actually flipped back into positive territory. The source partly attributes this to the recent LPG price hike.
Okay, and what about core inflation, if you strip out food and fuel?
The sources say core inflation was pretty steady and contained in March and April, although they do acknowledge gold prices pushed up some components within core during that time.
So looking ahead on inflation, what's the RBI's outlook based on these documents? Benign.
Largely benign, yes. Factors pointing that way include the record wheat crop, good pulse output recently, and critically, that expectation of an above-normal monsoon. That should really help Kharif crops and keep food prices generally subdued. They also mention that inflation expectations, especially among rural households, seem to be easing, which is a good sign.
But not entirely worry-free.
No, not completely. The sources say they're still watchful. Weather risks beyond the monsoon are always there, and also those evolving tariff issues globally that could impact commodity prices.
So factoring all that in, assuming a normal monsoon, what's the new inflation projection?
They've revised their CPI inflation forecast downwards for 2025-26. The new projection is 3.7% for the year.
3.7%, okay.
And again, they give a quarterly path, starting low at 2.9% in Q1, then 3.4 in Q2, 3.9 in Q3, and picking up to 4.4 in Q4. Similar to growth, they see the risks around this 3.7 forecast as evenly balanced.
Okay, that covers inflation. Let's pivot to the external sector, India's connection to the global economy. How's that looking?
The picture painted in the sources is pretty reassuring, actually. The current account deficit, the CAD, stayed low last year. In Q3, for example, it was just 1.1% of GDP.
Lower than the previous quarter.
Yeah, mainly thanks to strong services, exports, and remittances, money sent back by Indians working abroad.
Even though the sources mention the merchandise trade deficit, the gap between goods imports and exports widened a bit in April.
Correct. Imports grew faster than exports in that month. But the expectation is that continued strength in services and remittances should offset that. So the bottom line from the sources is that the CAD for this year, 2025-26, should remain well within sustainable levels.
And how's India financing that gap? What about capital flows?
Well, on the financing side for last year, 2024-25, there was a sharp drop in foreign portfolio investment, FPI inflows. In fact, it turned into net outflows of about US $2.1 billion so far this financial year, up to early June.
Outflows, why?
The sources suggest it might be partly foreign investors taking profits from the equity markets. Also, net foreign direct investment, FDI, moderated a bit in 2024-25 compared to the year before.
So moderation in net FPI outflows. Does the RBI see that as a major concern in the documents?
They actually address this directly. They make an interesting distinction. While net FDI moderated gross MDI, the total new investment coming in actually went up by about 14% last year.
Ah, okay, so more money came in, but maybe more also went out.
Exactly. They interpret the rise in repatriation, money leaving, not necessarily as negative, but maybe as a sign of a mature market where entry and exit are smooth. The key for them, they state, is that high gross FDI number, which they say shows India is still an attractive place to invest. They also note higher net inflows from things like external commercial borrowings, ECBs, and non-resident deposits last year.
And what about the safety cushion, foreign exchange reserves?
Very strong. The sources state that as of May 30th, 2025, reserves stood at a robust US $691.5 billion.
Wow.
They highlight this covers over 11 months of goods imports and about 96% of total external debt. So the overall assessment is that India's external sector remains resilient and key vulnerability indicators are actually improving.
Okay, resilient external sector. Let's switch gears now to liquidity within the banking system and, broader financial market conditions. The sources describe a shift here.
Yes, a noticeable shift. Banking system liquidity, which had been in deficit for a while, actually flipped into surplus towards the end of March 2025.
Why the flip?
According to the sources, it was due to significant durable liquidity injections by the RBI itself. They pumped in about 9.5 lakh crore since January. And you can see the surplus in things like the lukewarm response to the RBI's reverse repo auctions, where they try to absorb cash, and the fact that banks are parking a lot of money in the SDF, the lower end of the rate corridor.
And how did that surplus liquidity affect interest rates? The short-term ones?
Well, because there's plenty of cash sloshing around, the sources note that short-term rates, like the call money rate, have been trading down near the bottom of the policy corridor, closer to that SDF rate than the main repo rate.
Right.
They see this comfortable surplus as having helped pass through the repo rate cuts to those very short-term money market rates.
But the sources also mentioned that the transmission, the pass-through to actual lending rates for businesses and people, hasn't been quite as clear yet, although that often takes time.
Exactly. There's usually a lag. And this is where another quite significant measure detailed in the sources comes into play to provide more durable, long-lasting liquidity and really help that transmission to the credit market. There's a planned cut in the cash reserve ratio, the CRR. That's the slice of deposits banks have to keep parked with the RBI, earning no interest.
And how big is this CRR cut?
It's significant. A 100 basis point reduction, that's a full percentage point. It'll bring the CRR down to 3.0% of NDTL, basically their total deposits.
Wow, 100 basis point CRR cut is a major move.
Yeah.
That injects a lot of liquidity.
It really does. And the sources explain it won't happen all at once. It'll be staggered, 4 equal steps of 25 basis points each.
When?
Starting September 6th, then October 4th, November 1st, and the last one on November 29th, 2025. This phased approach, they estimate, will release about 2.5 lakh crore of primary liquidity into the banking system by December.
So this is a clear signal, alongside the rate cut, that the RBI wants to make sure banks have plenty of funds to lend out to support credit flow.
That's precisely the stated goal. Provide durable liquidity, help the transmission of the policy rate cuts into the credit market. It should lower banks' cost of funds and, hopefully, lead to lower lending rates over time. The sources are clear, the RBI is ready to provide enough liquidity and will keep monitoring things.
Okay. Lastly, let's touch on financial stability. What do the sources say about the health of the banks and the NBFCs, the non-bank finance companies?
The assessment there is largely positive, quite reassuring. The sources indicate that for both banks, the SCBs and the NBFCs, the system-level financial health indicators look robust.
Like what specifically?
Asset quality keeps getting better. Lower bad loans, NPAs, reported in December compared to the year before. Capital positions are strong, well above the minimum required levels, and liquidity buffers for banks look solid too.
Are there any areas they still flag for attention?
Yes, a couple of nuances. They note that the stress seen earlier in some retail loan segments, like unsecured personal loans and credit cards, seems to have eased off a bit.
That's good.
However, they do mention that stress in the microfinance segment seems to be persisting. But the sources also say that the institutions involved are apparently taking steps, tweaking business models, tightening lending standards, improving collections to manage that risk.
So this whole deep dive into the assessment provided in the sources covering global factors, domestic growth, inflation, the external accounts, liquidity, financial stability, it really paints the full picture behind these policy choices, doesn't it?
It absolutely does. It gives you the context for why the MPC felt confident enough about inflation to cut rates significantly, why they simultaneously shifted to neutral, signaling maybe less room for future cuts, and how they plan to ensure that easing actually feeds through with measures like the CRR cut.
And the governor's statement sort of wraps it all up with this compelling big picture view of the Indian economy. He talks about strength, stability, and opportunity.
Yeah, he uses that framework, the 5 by 3 by 3 matrix, he calls it. The strength, he says, is from the balance sheets of five key areas: corporates, banks, households, the government, and the external sector, all looking healthier.
Okay, that's the five. And the stability, the three.
That's stability on three fronts: price stability, financial stability, and interestingly, political stability. He argues this provides vital policy certainty in a pretty uncertain world right now.
And the final three, the opportunity.
That comes from the three Ds: demography, digitalization, and domestic demand. He frames this whole 5 by 3 by 3 structure as the core resilience that buffers India from global shocks and helps propel it towards faster growth.
So let's try and wrap up this deep dive then. We've seen the RBI make a pretty decisive move, cutting the repo rate by 50 basis points. The sources are clear. This stems from more confidence on inflation meeting its target and a desire to give an extra push to growth, which, while solid, maybe isn't quite where they want it to be.
Right. And that decision, combined with the shift to a neutral stance, which kind of signals, okay, we've done a lot of easing quickly and now we watch the data, and that planned CRR cut to inject more permanent liquidity. It all paints a detailed picture of their strategy, navigating global headwinds while keeping a close eye on domestic dynamics. We've really tried to pull out the specific assessments from the official documents that back all this up.
And the governor's statement leaves us with that powerful thought. Price stability isn't just about hitting a number. It's fundamental. It protects people's purchasing power, creates certainty for businesses to invest and people to spend. And, crucially, it helps equitable growth because inflation hits the poor hardest. But, he adds, stability alone isn't enough. You need supportive policy too, especially when times are uncertain.
Which really brings us to a key question for you, the listener, to think about. Given this nuanced assessment from the RBI, they see big opportunities domestically, but also real risks globally. And given this deliberate policy shift after rapid easing, how well positioned do you think this policy action and that whole 5 by 3 by 3 resilience framework actually leaves the Indian economy? How well can it handle those global uncertainties while still trying to achieve that higher aspirational trajectory for growth? What factors specifically do you think will be most critical in determining if this balancing act succeeds in the coming months?